Chapter 5-1 Accounting for Merchandising Operations. In this case, Panda Plaza is the buyer and Bamboo Wholesalers is the seller. Both use a perpetual inventory system. On July 2nd, Panda purchases $25,000 of merchandise, with terms 2/10, net 60. This means a 2% cash discount is available if payment is made within 10 days, otherwise, the net amount is due in 60 days. Panda also pays $280 freight. The merchandise cost to Bamboo is $18,500. On July 4th, Panda returns $1,200 of goods. Bamboo restores these items to inventory. Their cost was $900. On July 10th, Panda pays the balance within the discount period. Here's what we need to do. First, as the buyer, record the purchase with freight, the return, and then the payment with discount. Second, as the seller, record the sale and cost, the return, and then the receipt of payment with discount. Third, repeat the same steps using the periodic system instead of perpetual. The buyer uses purchases and freight in instead of inventory, and the seller waits until the end of the period to update cost. Finally, use the net method, record purchases and sales as if the discount will always be taken, then adjust only if it isn't. Now let's look at the buyer's entries under the perpetual system and the gross method. On July 2nd, Panda Plaza purchases merchandise worth $25,000. We debit merchandise inventory and credit accounts payable. Also on July 2nd, Panda pays freight of $280. We add this cost to inventory with a debit and credit cash. On July 4th, Panda returns goods worth $1,200. This reduces accounts payable with a debit and reduces inventory with a credit. On July 10th, Panda pays within the discount period. The balance after returns is $23,800. With a 2% discount of $476, we debit accounts payable $23,800, credit inventory $476, and credit cash $23,324. This shows the logic of the gross method: record purchases at the full invoice price, and recognize the discount only when payment is made. Now let's switch to the seller, Bamboo Wholesalers, under the perpetual system and the gross method. On July 2nd, Bamboo records the sale by debiting accounts receivable and crediting sales for $25,000. At the same time, the cost of goods sold is $18,500, so we debit cost of goods sold and credit merchandise inventory. On July 4th, Panda returns $1,200 of merchandise. Bamboo records this with a debit to sales returns and allowances and a credit to accounts receivable. Bamboo also restores the goods to inventory at cost $900, so we debit merchandise inventory and credit cost of goods sold. Finally, on July 10th, Panda pays within the discount period. The balance receivable after returns is $23,800. The 2% discount is $476. Bamboo debits cash for $23,324, debits sales discounts for $476, and credits accounts receivable for $23,800. This shows how the seller recognizes revenue at the invoice price under the gross method, and only records the discount when payment is actually made. Now, let's compare the periodic and perpetual systems, both under the gross method. The major difference is the accounts used. For the buyer, in the periodic system, we use temporary accounts such as purchases, transportation in, and purchase discounts. In the perpetual system, all changes go directly into merchandise inventory. Then, let's follow the transactions in order. On July 2nd, the buyer purchases $25,000 of goods on credit. Under the periodic system, this is recorded in purchases. The freight cost of $280 is added to transportation in. On July 4th, the buyer returns goods worth $1,200, which is recorded in purchases, returns, and allowances. Finally, when payment is made within the discount period, the buyer records the $476 discount in purchase discounts. So why is this difference important? Because in practice, the periodic system spreads activity across several temporary accounts, while the perpetual system keeps everything inside inventory, giving managers up-to-date inventory balances. Now, let's turn to the seller side and compare the periodic and perpetual systems, both under the gross method. The main difference is in the accounts. Under the periodic system, we record only sales, returns, and discounts. Cost of goods sold is updated later, at the end of the period. Under the perpetual system, we record both sales revenue and cost of goods sold at the time of each transaction. Let's walk through the dates in order. On July 2nd, the seller records a credit sale of $25,000. Under the periodic system, this entry records sales only. On July 4th, the buyer returns goods worth $1,200, and the seller records sales, returns, and allowances. On July 10th, the buyer pays within the discount period, and here both systems record the same entry: debit cash, sales discounts, and credit accounts receivable. So why is this difference important? Because under the periodic system, cost of goods sold is determined only at the end of the period. But under the perpetual system, the seller always has up-to-date information on both sales revenue and inventory costs. Now, let's look at the perpetual system under the net method. The key idea of the net method is that the buyer assumes the discount will be taken from the very beginning. So purchases are recorded at the net discount amount. On July 2nd, goods of $25,000 are purchased but recorded at $24,500. Debit merchandise inventory and credit accounts payable. Freight of $280 is added to inventory. On July 4th, goods worth $1,200 are returned, recorded net of discount at $1,176. Both accounts payable and inventory decrease. On July 10th, the buyer pays the balance. Accounts payable of $23,324 is cleared, and the same amount is paid in cash. So under the net method, we treat the discount as if it will always be taken. This makes entries slightly different at the start, but if the buyer pays on time, no adjustment is needed later. Now, let's look at the seller side under the net method. On July 2nd, the seller records a credit sale of $24,500 instead of $25,000, and at the same time records cost of goods sold $18,500 and reduces inventory. On July 4th, the buyer returns goods with a net value of $1,176. The seller reduces accounts receivable and sales returns and allowances, and restores inventory $900 while reducing cost of goods sold. On July 10th, the buyer pays within the discount period. The seller simply debits cash $23,324 and clears accounts receivable for the same amount. So what does this mean in practice? Under the net method, both the seller and the buyer recognize discounts right away, assuming they will be taken. This reduces the need for later adjustments and ensures that revenues and receivables are consistently stated at their expected collectible amounts. Let's wrap up this quiz with 3 key ideas. First, perpetual versus periodic systems. In the perpetual system, every purchase, return, or freight cost updates the merchandise inventory account right away, and the seller records both sales and cost of goods sold immediately. In the periodic system, we use temporary accounts like purchases and freight in, and cost of goods sold is only determined at the end of the period. Second, the gross versus net methods. Under the gross method, we record at the full invoice price and only recognize a discount if payment is made within the discount period. Under the net method, we assume the discount will be taken, so we record at the discounted price right away. If it's missed, we adjust later. Finally, the transaction term, 210, net 60. This means the buyer earns a 2% discount if payment is made within 10 days, otherwise the full invoice amount is due in 60 days. In our example, after returns, the balance was $23,800, so the 2% discount was $476. This quiz is a bit harder and needs more practice and careful thinking. It's designed to challenge you and help deepen your understanding. That's it for Chapter 5-1. Great work. See you in the next session.